Okay, well, we are in chapter 17, getting near the end. This is course video 27, the spot exchange market. And the market is for the British pound. There must be a price of pounds. In the foreign currency markets, the price of one currency is the amount of another currency you must give up in order to obtain the currency. So this is the market for the pound. The price is the dollar price of the pound. So when you see this dollar slash pound, it's actually slightly different from the what you'll see in the Wall Street Journal, but the dollar price of the pound is how many dollars does it take to buy 1 pound. Okay, and then we have the quantity of pounds measured on the horizontal axis. So this can be quantity of pounds. We could measure it probably in billions per day. There's a lot of currency trading. A lot of it is speculative, and some people don't like speculators, but actually they make the market, which means that they provide the liquidity necessary for people who have what you might consider more legitimate reasons to hold current or buy currency, like to trade goods and services. So here we have a downward sloping demand curve for the pound. And that just says that if the pound is expensive, people demand fewer pounds. So the demand for the pound is a function of the demand for goods and services, British goods and services, goods from the UK, etc. And then if people want to buy assets, British pound denominated assets in the UK. So obviously if you were going on vacation in London, if the pound costs $1, then things are going to seem very cheap. And if the pound costs $2, things are going to seem very expensive if you're an American. So you're very sensitive to the exchange rate in terms of how much British goods and services and assets you wish to acquire. You might buy British government bonds or stock in British companies or houses if the pound gets cheap. So we have this downward sloping demand curve for the pound, and then we have an upward sloping supply curve for the pound. And the supply of the pound in this two-country world comes from the desire on the part of British residents or people who hold pounds to acquire American goods. So they want to buy US goods, and they might want to buy US government bonds or stock in Google or something like that. So the supply comes from the desire to change pounds into dollars in order to buy American goods or go on vacation in the US. So we have an upward sloping supply curve and a downward sloping demand curve. And as usual in economics, it's always interesting where these things cross, because this is the only price of the pound, so that the desire on the part of suppliers of pounds is exactly balanced by the desire to demand pounds on the part of people who currently hold dollars. So we have the equilibrium exchange rate. We can call that E star. Equilibrium exchange rate. And this is a currency that is currently in equilibrium. There's no monetary authorities interfering at this point. And it can respond flexibly to changes in the demand and supply conditions. So let's imagine that we end up with an increase in the supply of pounds. Let's think about that. So maybe the British have decided that America is very fashionable right now. So this is a change in taste. This is an increase in the supply of pounds unrelated to the price of pounds, because of course if the price of the pound just changes, then you move up and down existing curves. So it has to be something extra. So there could be an increased taste for American vacations because America becomes fashionable. Some movie is shown and everyone wants to go to the place where it's shown, where it was filmed, I don't know. all sorts of odd places, or could be that suddenly people find the US assets more desirable. There's a change in preferences. Perhaps Brexit makes people nervous, and so they all decide to get out of the pound denominated assets. So you have an increased supply of pounds, which essentially what we're saying is equivalent to a demand for the dollar. So we could have drawn the dollars market, which would be the mirror image of the market for pounds. So then, of course, the demand for the pounds is the same thing as a supply of dollars. So I could have drawn the market for the dollars. Anyway, so as you can imagine, in a floating exchange rate regime, if you have an increase in the supply of pounds, this will cause the equilibrium exchange rate to change. So we have a fall in the value of the pound. We say that a rise in the supply of pounds leads to a depreciation of the pound. And depreciation means a fall that occurs naturally in a floating exchange rate. And then one last thing that might be interesting is, well, what if we have a fixed exchange rate regime, which has been quite common. And so a fixed exchange rate regime is one where the monetary authorities announce that they intend to defend a particular exchange rate. And it could be for the purposes of just long-run stability. If everyone knows where they stand with the exchange rate, they're more willing to enter into transactions with with people in other countries because they know what the price of the currency is going to be. But let's suppose that we have a fixed exchange rate regime so that the initial price happened to be the equilibrium. But if we fix the exchange rate at that initial equilibrium, you can see why we get into trouble, because what we have here is we have a sort of a natural shift in the supply of pounds, but we have the demand for pounds staying the same. So this is the demand for pounds at the fixed exchange rate, but the new supply of pounds means that we have this excess supply of pounds. So we have, if we fix the exchange rate at the original ESR, we have this excess supply of pounds as underlying conditions in the market change, and it's going to be the job of the monetary authorities to do something about that. So under a fixed exchange rate, the excess supply of pounds is going to end up with either the British government having to run down their foreign currency reserves to defend the value of the pounds. This is what happened under Bretton Woods by the Bank of England. And eventually they run out. So if it's the job of the British to maintain stability in the value of the pound, and the pound is trying to depreciate, then they're going to have to spend their currency reserves of dollars to try and prop up the pound, but that can only go on so long. Eventually currency reserves get too low. If this was the US with the attempt, downward pressure on the dollar, then that's not as difficult for the US, because other countries will tend to like to accumulate the US dollar as an reserve currency. So in the 1960s, Britain used to have continual currency crises where they were in the fixed exchange rate regime. They were not particularly competitive in terms of the goods that they produced. So people didn't really want to buy British exports, and there'd be downward pressure on the British pound, and then the Brits would have to start running down their official reserves of dollars, and periodic crises. They once had to go to the IMF for a bailout, which they found very humiliating. But a fixed exchange rate regime does put a lot of pressure on these currencies that have downward pressure because they're not particularly competitive, meaning that people are supplying their currency to get out of it. They would rather have other people's assets and other people's goods. But that's the inherent problem with a fixed exchange rate. if you have sort of persistent deficit or persistent surplus countries, you get this adjustment. The surplus countries tend to be sitting pretty, but usually the adjustment falls on the deficit countries.